Please take a moment to review the disclaimer on the screen. By attending this webinar, you acknowledge and agree to these terms. I'd like to introduce our moderator, Max Kraus. Max is a senior manager who specializes in audit and works on a variety of engagements ranging from financial statement compilations and reviews to audits and attestation services, working primarily with not-for-profit and manufacturing clients. Max also performs numerous benefit plan audits, including 401k plans, health and welfare plans, pension plans, and multi-employer plans. He also works closely with plan sponsors and assisting them with DOL and ERISA compliance matters. I'll pass it to Max to introduce our presenters and kick things off.
Thanks, Allie. Hey, everyone. I'm Max Kraus. Clark Shaver Haggett has done a couple events, webinars focusing on the One Big Beautiful Bill Act, specifically for-profit organizations and individuals. So what we wanted to do is have something that focuses more on the tax-exempt organizations. And while the impacts are not as vast, because it is kind of focusing on tax, we did want to highlight those changes that will impact tax-exempt organizations and help alleviate any uncertainties or doubts over what might be changing there. And then we also want to go into some of the areas of focus that may be, not new, but we see increased focus on year after year. And then also just some pitfalls, so common errors that we see and how you might address those. So as Allie mentioned, I'm an audit guy, so I'm happy to have two tax senior managers here, and Anna Marie Riley and Natasha Carr to present. I work with both on a daily basis, have tremendous knowledge and insight, and I go to with tax questions. So I'll just give a quick background on each. So Anna Marie Riley is a tax senior manager who's responsible for reviewing tax returns, managing tax engagements, and teaching and developing our staff. With over 20 years of experience in accounting and tax, she has developed deep expertise within the not-for-profit and high net worth individual spaces. Anna Marie specializes in complex engagements, including research, planning, and compliance. Natasha Carr is a tax senior manager who specializes in working with not-for-profit organizations. She has a passion for helping her clients fulfill their mission and helps them file their 990 in a way that both conforms to the IRS rules and communicates the organization's accomplishments more effectively to potential donors. Natasha also has experience in helping tax-exempt organizations determine if they are subject to unrelated business income tax. So we'll first kick it off with a poll question. If you're here for CPE, we're not going to leave them up on the screen for very long, just in the interest of kind of keeping things moving. Just make sure you're answering before the next poll question comes out, and you can, if it goes away on the screen, you can find it in the chat. So in the interest of, January of 2026 and looking forward to the next year, what do you think will be your organization's greatest challenge for 2026? Staffing, uncertainty with funding, cybersecurity, or something else? And with that, I'll hand it over to Anna Marie Riley.
Good afternoon, everybody. I'm Anna Marie Riley. I'm just going to run through the table of contents here quickly. So as Max mentioned, we're going to be going over the effects of the OBBBA and its effect on tax-exempt organizations. Some of these can be direct, some of them are indirect. And then to kind of round everything out, since there weren't a ton of changes, we're also going to be going over the 990, page 1 and 2 in parts 5 and 6, just kind of a general overview of the 990. And then we're going to look a little more in-depthly at the Schedule A. Natasha's going to talk about some lobbying, and we're going to look at Schedule R, which is related organizations. And then at the end, if we have time, which we may or may not, but if we do have time, Natasha's going to go over some tax credits and energy efficient improvements that are going to be expiring. So with that, you can go to the next slide and we'll talk about the OB3A. That's what I've been trying to call it with all the B's. I feel like it's easier to just say OB3A. So Okay, so the big thing with this and why we've been saying it's not a ton of changes is one of the major things OB3A did was to make a lot of the provisions from the Tax Cuts and Jobs Act permanent, rather than making some changes on its own. And so when we say permanent in tax law, you kind of got to think in your head, it really means semi-permanent. It doesn't mean it's never going to change. It can, of course, change if there's a law change, but it's not scheduled to change. So that's what they mean when they say permanent. So first, we're going to go over things that didn't make the final bill. And the reason for this is if you guys were following the OB3A as it progressed, there were a lot of things that were proposed, and some people get confused, like, oh, that was proposed, did it end up happening? So just wanted to run through some of the things that didn't make the final bill. And this first one here, the parking tax, is my favorite one because I was so happy that it didn't pass. I was kind of watching this progression with bated breath. Please don't put the parking tax back in, because if anybody remembers the parking tax that was introduced by TCJA, it was terrible, because what it basically did was take a benefit to employees by having free parking, and it turned that into a tax on the entity. So entities were having to file 990Ts, and maybe that was the only thing on the 990T to pay this tax. So everybody hated it, and it ended up being repealed. And so there was a lot of talk about bringing it back, and I'm thinking, why are you going to bring this back? It was terrible. It was repealed. So happy that that one did make it in. So always like to put everyone's mind at ease. No parking tax. Now, there were some discussed changes to UBIT, and they were going to expand the definition to cover revenue coming from names and logos, but that did not make the final bill. There was a proposed increase to the tax on private foundations. I don't know if anybody remembers, there used to be 2 different taxes for private foundations, and they simplified it by doing the one flat rate of 1.39%. So they talked about increasing that back up, but that did not happen. It stayed at the 1.39%. This one was a big one. There was a proposal that if you were suspected of supporting terrorism, they could just take away your tax exempt status without due process. So a lot of people, brought this up that, if you didn't like something else about the organization, maybe you didn't agree with their mission, you could say they were suspected of terrorism and get their tax exempt status revoked. And so, everybody said, hey, that doesn't sound fair. That could be abused. So that did not make the final bill. And then there were 2 proposed changes to the university endowment taxes that did not make the bill. And that was a top rate of 21%, which that would have been a very high tax rate to implement on them. And as well as a religious exemption for affiliated schools, which did not make the final bill. But on the next slide, we are going to talk about some things that did change with the university endowments. So what this is kind of like a private foundation, how they're taxed on their investment income. Private universities have to pay taxes on their investment income, unlike your typical charity or tax exempt organization that does not pay tax on their investment income. So they did make some changes to this. There were 3 big changes that did happen. The definition of taxable income was expanded to include student loan interest and federally subsidized royalty income. The tax rate did go from a flat 1.4% to a tiered structure going up to 8%. So while it did not go up to the 21% that was proposed, it did go up to 8%. So the tax rate is increasing on these university endowment funds. But the other thing they did was, when this first came out, it used to be applicable to institutions with 500 tuition paying students, but they increased that threshold to 3,000 students. So while the tax rate went up, it's also being applied to fewer organizations, and really only about 30 institutions are expected to be affected by this tax. Okay, so some other changes. It used to be that if you paid somebody in your organization over $1 million, you had to pay tax on the amount over the $1 million. This was called excess compensation excise tax. So if you paid somebody $1,500,000, you had to pay an excise tax on the $500,000 piece. And when this first came out, it was only applicable to the top 5 earners in the organization. But under this new law, it applies to anyone making over $1 million. So that is something to really watch out for, because, if you miss this, there could be penalties. So just make sure it's anyone in the organization. Well, not anyone. There are some exceptions if you're like, a medical doctor. But for the most part, be on the lookout for anyone making more than $1 million. Now, this next one here, this is actually going to be, I think, a really good thing for our charities, because the OBBBA did make permanent the bigger standard deductions. So standard deductions used to be smaller, so a lot more people itemized. They made it permanent that it was a much larger deduction. So about, I think, 90% of people are actually taking the standard deduction. But what that did was it made it so you didn't have as much of an incentive to give to charities. If you were, some people are doing it just because they're tax motivated. So, that kind of took that away, because they were getting no benefit because they were taking the standard deduction. So now you can take the standard deduction and you can get $1,000 or $2,000 deduction in addition to that, even if you're taking the standard deduction. So that is really giving people an incentive to give, or if they were already incentivized to give, just, because they believe in the cause, they could potentially give a little bit more, but they're getting a tax benefit. So then, they're kind of in the same place they were before. So that could be a good thing, for people to bring up, that they're getting a nice tax benefit now for $1,000 or $2,000. One thing that it hasn't happened yet, this is set to change for 2027, is it created a new credit up to $1,700 for donations to scholarship granting organizations. So, this is kind of like a good thing, but could maybe be a negative thing for some other organizations, because, people might take their dollars that they would, give to any organization. If they start funneling their dollars to these scholarship organizations, they're getting a better tax benefit for it, which is great. But there is the potential that it could start, taking away some of the smaller dollar donations from other organizations. So hopefully that's not going to, negatively impact too many people, but something to look out for. Okay, I'll go on to the next one. Okay, so this is also a good thing right here. This first one for charities, it is permanently retaining the 60% limit on charitable contributions. So previously, prior to TCJA, you could only deduct up to 50% of your adjusted gross income. So it was increased to 60%, which means, you can give a lot more and still get a tax benefit for it. So it permanently retained that. So that is a good thing for people, for the charities, because it gives people a nice incentive to give. Now, the next one is, it's kind of like this back and forth. Some are like, oh, good, that's great. And then you get to the next one and you're like, oh, that's kind of a bummer. So this next one, I'd go with kind of a bummer, because it introduced a charitable deduction floor. So what that means is you have to give over a certain amount of your income before any of it becomes deductible. So if you have, $1 million, I'll just use $1 million because it makes it easy. If you have $1 million in income, you have to give over $5,000 before any of that is deductible. So that first $5,000 is going to be lost. You're not going to get to deduct that ever. So, if you have a much lower income than that, then of course, it's getting, harder to get over, this floor. So one thing, they did a similar thing I want to throw in with corporations, same way. So one of the things we have been suggesting to people is bunching, and we've been suggesting bunching now for a number of years. And one of the reasons is because of that standard deduction being so high. It's 30 something $1,000. So if you think about it, if you give $20,000, which that's a nice contribution, you might not get any benefit for that, because that might not get you over, that's not going to get you over the standard deduction. So if you bunch, say you take 3 years of your contribution, so instead of giving $20,000 in years 1, 2, and 3, you bunch that, you give $60,000 in 1 year. That is going to get you over the standard deduction, way over. And also, you're only going to be subject to this floor that first year, instead of you'd be subject to the floor each year. So if you concentrate your contributions, that is a great strategy. And you can do that maybe with a donor advised fund, where you can put those dollars into a donor advised fund, and then you can divvy them out each year. So the charity's still getting money each year. So they're not, getting left out years 2 and 3. Or, if your dollars aren't big enough to want to start a donor advised fund, you can always just give it the 1 year to the charity, and then you would get a better tax benefit for that. And then this third one here is also not a great thing for our charities and the, incentivizing them, because what they're doing now is if you're in the 37% bracket, it used to be if you gave to charity, you're getting a benefit of 37 cents on the dollar because you're in the 37% bracket. So now if you're in that bracket, they're changing it so you only get a benefit of 35 cents on the dollar instead of 37. So you have to reduce it's actually on all itemized deductions, not just charitable contributions, but you have to reduce it by 2/37. So while it's not a huge dollar amount, and I would, want to, make sure people know that 2/37, isn't huge, but it's just an added complication, and, people don't like things to be complicated. So it's just, another thing that might make people not want to give as much, but I think it's important that you highlight that it's 2/37. It's not a big dollar amount. So just something to be on the lookout for. Okay. Looks like we have a poll question.
Okay, next poll question. How's everyone feeling about the One Big Beautiful Bill Act? Optimistic, concerned, or indifferent?
And now I'm going to pass it over to Natasha to talk about an overview of the 990 form.
Thank you. Thanks, Anna Marie. So we're just going to go through, really, these are going to be common pitfalls that we're seeing on the information pieces of the 990. So on the next screen, the first thing we want to make sure everyone is aware of is that your return has to be electronically filed. It doesn't matter if it's a 990, 990EZ, 990N, it has to be electronically filed. And the IRS, they view an incomplete return the same as it never being filed, or a paper filed return the same as it never being filed. So it's extremely important that you are electronically filing these returns. Now, we've had clients have issues with the electronic file system, and there are times that happens, and we have to work through it. So the IRS, on here, you'll see it says it rejects electronically filed returns that aren't matching the type that's in their database. So sometimes, for whatever reason, in the IRS master tax file, a return might get changed from a 990 to a 990 PF, or vice versa. And that will reject automatically when you go to e-file. So you need to be careful of what your return type is, and just be as cognizant as possible about getting that filed electronically and timely. An incomplete or unfiled return, so if you paper file it, it's unfiled, has very steep penalties. It's $20 per day. Each day the return is late, up to a max of either 5% of gross receipts or 12,000, whichever is higher. However, if you have a larger return that or organization that has gross receipts over 1.2 million, those penalties go up drastically. So it's $120 a day, up to a $60,000 penalty. And that's a lot of money for organizations. So this is a really important piece of filing your 990. Just right off the bat, not even getting into the form, just filing it is a place that the IRS can get penalties. So you need to be sure that you're doing that electronically. Okay. And so I think we've said a couple of times, the 990 is an informational form. There's more to the 990 than just financials. In fact, the most important parts of the 990 aren't the numbers at all. Honestly, most of our clients, we pull the numbers from the audit. They're just kind of like pulling from one place and putting them on another place. It's the other information that really is the most important pieces, and that's what the IRS is going to be looking at. So sections of the return, parts 1 through part 7 of the core form, really is all non-financial data. It's not anything to do with your income statement, nothing to do with your balance sheet. And those are the important pieces of this form. So we're going to look at 1 through 6. We're not going to go through 7, which is your board list. But we're going to look at those sections and what are the common pitfalls on those sections of the 990, just because they are so important. And I know some people might think, well, there's nothing financial on them. But again, that's the most important pieces. It is informational form, but this is where you can get penalized the most. So let's start off. So part 1. Right at the beginning of your form, page 1. This is supposed to be a snapshot for the organization. It should be just your brief financial data, balance sheet, income statement, and then just a snapshot of your organization's mission. The mission statement should be concise and presented in one sentence on the front of the form. And then that financial detail comes from other sections in the return that has it all pulled from an audit or a review compilation, such as those types of places. The common mistake here is having a run-on mission statement. Honestly, this section is meant for a donor to come see your return, not have to flip to any other pages, and just see, okay, this is where they are financially, and this is what their mission is. There is another section in the return where you can have a very robust mission, where you explain everything that you're set out to do. But the mission on page 1 should be one sentence, so very brief. And we typically see organizations trying to make that the robust section. The idea here is for someone to not have to flip back to a Schedule O. So try to make it one sentence. The next page is page 2 or part 3. You'll notice I skipped part 2. That's just a signature block. It's where we sign as your preparer. That's where you sign as the executive director or treasurer or CFO. Part 3 is the next section that really matters to the IRS, and it's the statement of program service accomplishments. And this is the section that provides the organization an opportunity to boast about themselves. So this is where you get to tell the world what your organization is doing and all the great things that you've accomplished, right? Line 1, this is where that expanded mission goes. So that mission statement from part 1 no longer has to be one sentence. I believe it can even be like a paragraph. I'm pretty sure you have 4 lines on the 990 that you could utilize. And so definitely elaborate on what that mission is of the organization. Lines 2 and 3 are if you have any new significantly changed or ceased programs. So on this section is where you list your program service accomplishments. That's what line 4 is. And line 2 and 3 is telling the IRS if there's anything you've done differently. So when you do your 1023, your 1024, you tell the IRS what it is you're set out to do. If there's any changes to those, or you pick up any new programs, I know a lot of organizations that have had a new program come into play. This is where you would tell the IRS of those. And if you cease a program, sometimes programs fizzle out. Sometimes it's an adjustment to funding, or it's just a program that no longer serves the organization. just let the IRS know that you ceased that program in this section. So the common mistakes in this area is failing to report those changes to those programs. Why this is so important is because when you asked for your exempt status, you told the IRS what you were going to be doing, and they approved those. But if there's changes to that, they are able to come in and challenge any of those no programs as unrelated, which could result in unrelated business income. So if you are changing things or seizing the programs that were previously approved, you need to indicate that. So that's why this section is so important. Another error that we see here is being too concise on the program service accomplishment. This is one of my biggest pet peeves, is when I get a new client return and the program service accomplishment is one sentence. Like, this is your time to tell the world everything great you did. How many people did you serve? What did you do? What did you accomplish this year? And I see too often like one sentence of what you did. So make sure you're boasting about yourself. This is your opportunity to do that, and it can be paragraphs long. It doesn't have to be one sentence. The next mistake here is not reporting, revenue, expenses, and grants for all C4 and C3 organizations on line 4. And then to go with that, not accounting for all the program service expenses from part 10. So on part 3, you do list your top 3, but there is a line for all other. And if you have smaller programs that maybe don't fit into those top 3, you still need to make sure that you're including all of their expenses in that other program line to make sure that you're tying back to that part 10 for your expenses. Okay. Part 4 is we're not going to go over super, like a lot of common mistakes. This one is the checklist. So this is the 2 pages of questions that really tell you if your return is going to go from a 12-page return to a 112-page return, right? So answers to these questions on these 2 pages will determine which additional schedules you need. Like I mentioned earlier, an incomplete return could be rejected or considered not filed. So if you incorrectly check one of these boxes and miss a schedule, technically that could be an incomplete return. Any yes answer will indicate a schedule or part of a schedule that needs to be added. Common mistake here is not reading each question carefully to ensure a complete and accurate return. I have been doing this almost 20 years, and in those years, I like to this day, sometimes I will go to the instructions to make sure I'm including the right thing or making sure I understand what exactly are they asking me here? Because some of those things aren't straightforward on part 4. So just make sure you're really reading each question carefully. Okay. Part 5 is the statement regarding other IRS filings and tax compliance. This section is really where the IRS can get a lot of penalty money from an organization. It's a highly important section. There's an IRS emphasis on this section as it alerts readers and the IRS to potential other filings. Those filings being numbers of W-2s and 1099s. Are you considering your common paymasters? Because they need to be considered. If the organization has any type of legal fees greater than $600, there should at least be one 1099. In addition to the other filings, did the organization solicit non-taxable contributions? Are you a member organization that sends out due statements? If so, did the organization notify the donor that it's not deductible as a charitable contribution? There's specific verbiage that needs to be on letters that indicate that it is not deductible as a charitable contribution. If you're not doing these letters and you don't have that specific verbiage, there could be a penalty per letter. So that's a very important section. In addition to that, you can go to the next page. The additional questions that also could generate penalties for an organization are 7A and 7B. Did the organization receive money in excess of $75, partly for a contribution and partly for goods and services? A fundraising event will typically require a 7A to be yes. What this means is I have a gala. It's $150 to attend the gala. And the price of my dinner and drinks was $75. I should be receiving a letter that says, thank you, Natasha, for attending our gala. You received goods and services of $75. Thank you for your charitable contributions of $75. You have to be sending those letters, or you can get a penalty per letter up to a max per event. So again, this section is all about additional funds, essentially the IRS can gather from an organization that doesn't typically pay tax. So the common mistakes we see here: failure to file 1099s could result in 28% backup withholding. The IRS is using automated systems to match vendors in Form 1099s to filed reports on returns these days. There's more artificial intelligence measures that are determining audit candidates by the IRS. And then the penalties for not filing the Forms 1099s can vary and can be over $600 for each intentional disregard. The intentional disregard is important. There are letters that get sent out if there are questions, and I've had some clients send me their letters about 1099s, but just make sure that you are addressing 1099s if you have any kind of independent contractors or vendors. And if you have an accountant, check with your accountant if you're not sure if they need a 1099 or not. Not having proper verbiage on your due statements indicating non-deductibility. Penalties can be assessed on that. So make sure if you're a membership organization and you have those member letters going out, those due statements, make sure you have that verbiage. And then having the gala and not sending the thank you letters indicating that they received goods and services. Those are the common mistakes in this area. And then the last section that we will go over in the core form is the Part 6, and that's the governance, management, and disclosure. This is an extremely, extremely important section of the 990. It's one of the most important sections, according to the IRS. They consider it their crown jewel. That's what they actually call it. And it tells the IRS all about the organization's governance. So if an organization has a well-run independent board, they are more likely to not have private endowment issues or any kind of self-dealing, those kind of things. And the IRS sees it as best, it's a well-run organization. So this section is split into 3 separate sections. Section A is the governing body and management. So this is all about the makeup of the board. So number of independent voting members. I will make a note here. We're not going over Part 7, I had said, but there is a difference between Part 7 and Part 6. Part 7 asks for any board member that sat on the board even for a day, you have to list on Part 7. Part 6, the numbers they're asking for here are the number of voting members or board members at year end. So year 630. At 630, how many voting members did you have and how many were independent? They don't care if there was someone that sat on the board for a month and then left. So there's a little bit of a discrepancy there, and there might not be a matchup from your Part 7 and your Part 6. If their organization has an executive committee that makes governing decisions, the IRS wants to know that as well. You need to list any family or business relationships among board members. And then if there are any board committees that can make decisions on the board's behalf. Section B then follows that up with the policies and procedures. So you tell the IRS the makeup of the board. Now you're going to say, what are the policies that they have to adhere to? So does the organization have a 990 review process? What is it? Does the organization have a conflict of interest policy, a whistleblower, and document retention policy? If so, what is it and how is it enforced? How is compensation determined and is it reasonable? Is there comparability data used? And then is the organization involved in any joint ventures? So again, this is all about how the organization, what policies are put in place for those individuals leading the organization, what do they have to follow? And then Section C is the disclosure. In what states do you file your return? And how does the organization make its return and governing documents public? Okay, so the common mistakes here. Like I mentioned, listing the total number of board members at any given time instead of year end. So that's tying it just to your Part 7. We see that frequently. Improperly reporting or neglecting to report family and business relationships. I know that this is a sticky subject for some people. You do not have to say what the relationship is. You just have to say Jane and John Doe have a familial relationship. You don't have to say how they're related. Or you can say John Smith and John Doe have a business relationship. No further details have to be given, but you do have to indicate the individuals that have those relationships. And if it's familial or if it's a business. So you don't have to get into the details. Another common mistake is failing to completely describe the conflict of interest policy on Schedule O. It is not enough just to say we have one. You have to say, how is it monitored? Who has to adhere to it, and those kind of things. So make sure it's a robust description of the policy and how it is managed. And then also indicating the organization provides a copy of the completed return to the board prior to filing without doing so. I can't tell you the number of times we've seen the box checked yes, that we provide it to our board, but then we flip to Schedule O and the description says that it's the board treasurer and the executive director to review it, and then it's filed. Well, then you haven't actually provided it to your board. So if you are not doing that, it is better to mark it no and actually describe your policy than mark it yes and not do it. So just make sure that if you're saying that you're providing it to the board prior to filing, that you're doing that. It can be in an email. You can email it to them. It doesn't have to be a formal meeting that you hold, but just make sure that you're being consistent. And if you say you're doing it, you're actually doing it. And then indicating the conflict of interest policy and other documents are available upon request when the organization might not want to do this. That is not a requirement. The requirement is to provide your 990. You do not have a requirement for the conflict of interest policy and those other documents to be available upon request. But if you were saying you're doing it, make sure you're doing it. But you might not want to be doing that. So just be cognizant of that and check that box appropriately. Okay.
Okay, our next polling question. Would you like CPE credit for today's event? I think back to Anna Marie.
All right, remember to come off mute. So we're going to go over some of the Schedule A processes. So you can go on to the next slide. Okay, so Schedule A has to be completed by 501c3 organizations that are public charities. And the purpose of this is to say which public charity status you fall under, and it also differentiates you from a private foundation. And why this is kind of especially important right now is, a lot of organizations have been having issues with federal funding. Maybe you've lost some federal funding and you're looking for ways to make up that shortfall. So you might be like, oh, we have this, great donor. Maybe we could just talk to them and maybe they'd be willing to give us a little more money, which is, can be great, but it could also affect your public support percentage, which would not be good because a person contributing to your organization is not going to be treated the same way as government funding. So it's something you need to be careful of when you're out there, looking for ways to make up these shortfalls. So you can go to the next slide. And we're just going to go over the two types of public support tests that you're going to find on the Schedule A. So the first one is for these 170B1A4 and 170B1A6 organizations. And I always like these two because they're inverses of each other, the 4 and the 6. And I don't know if they did that intentionally, but it just always kind of pops out at you right away. If it's that 4 or 6 that it's going to be completing part 2. So it's kind of just an easy way to remember that. So these types of entities are operated for the benefit of a college or university or operated by a government unit, or this second one, the 6, which is the one we see most often, is normally receives a substantial part of support from the general public or the government. And then the other type of entities are the 509A2 organizations. They're going to complete part 3. And those organizations are the ones that primarily receive support through their tax exempt purpose. So their program service revenue versus contributions or grants from the government. So Schedule A is complicated and often done incorrectly. And the reason, I think a big reason for this is, if you think about, a tax software, often you put something in the input form and it kind of goes where it needs to go. It if you're doing like a 1040, it's going to go to the Schedule A or the Schedule B, and then all that's going to flow to the 1040, and it just kind of, a lot of it will populate itself. Well, a Schedule A of the 990 doesn't really work that way. You don't put in contributions on Schedule B and then automatically those flow to Schedule A. It just doesn't work like that. It's its own separate input form. So you have to compare it to the revenue, and you have to input things where they go on Schedule A by pulling it manually from the statement of revenue. So that can cause, some issues. There's diagnostics on, a lot of tax return software, but I've noticed that Schedule A it doesn't capture things in diagnostics like other parts of the return do. So it doesn't always, or hardly ever really, alerts you maybe if something is in there incorrectly, which I think is a lot of the reasons that some of these line items can be missed. All right, go to the next one. Okay, so when you're looking at Schedule A, what you're really trying to see is out of all of the money that the organization brought in, how much of that is public support. And one of the big things, though, is the unusual grant exception. And this is important because if you get a large, really large dollar amount, it could potentially impact your public support percentage. But there is a carve out for this. So if it's so large and unexpected and could impact your public support test, you might not have to include it. And that's if it's a material contribution or a bequest from a disinterested party. So you kind of think about this if, somebody's not really been involved in the organization, they haven't been giving every year, but in their will, they left a bunch of money. So suddenly you're getting this huge windfall from this person who, just died. It's unexpected. They weren't involved in the organization. And then you look and you think, oh my gosh, this number is so huge, it could make it look like we're not publicly supported. Well, if that's the case, you can consider that an unusual grant, and it's not going to affect your public support percentage. But if that person had been giving to your organization every year and then they died, you probably knew that it was in their will. It's not a disinterested party. They were an interested party. They were already giving a lot of money to your organization. Then that's probably not going to fall under the unusual grant exception. Okay, so other than that exception, that we got that one out of the way, we'll talk about the main way that you're going to be looking at the public support percentage calculation every year. So the public support is a 5-year rolling schedule. So it consists of the year you're working on and the 4 years prior to that. So it's a fraction. So the numerator is going to be certain public support that you received, and the denominator is basically all of the support you received. So when you go to the Schedule A, it's going to direct you to if you're going to be doing Part 2 or Part 3. So like the Part 2 I said was that 4 or 6 in the Roman numerals, and the Part 3 is for the 509A2 organizations. If you fail one of these, you can always try the other one to see if you might pass using that other one. And you don't have to alert the IRS to this. You don't have to make any formal changes. You would just change it the next time you do your 990. But one thing I did want to point out is the 509A1 status is looked upon more favorably than 509A2 status. So if you're already passing that first test, you're not going to want to switch to the second test. But if you're doing the second test and you fail that one, you could switch to the first one, and that would be great. You can switch either way, but if you're passing as a 509A1, you wouldn't want to do the other one. So new public charities are given a 5-year grace period. If you pass in the first 5 years, then in the 6th year, you're going to be a public charity. If you don't, if like you get to your 6th year and you're failing, then you might need to become a private foundation. So there's also a 10% facts and circumstances test that you might be able to pass. You know, you basically have to state your case as, you know, you're under the 33 1/3, but you're over 10%. So you can kind of make a case that even though you're not passing the test, you still should be a public charity. But of course, it's always best to just pass the 33 1/3 test, because the IRS can always disagree with your facts and circumstances and say, no, we don't agree with that. And you could lose your public charity status. And if you don't qualify as a public charity, then the big change is going to be that your investment income is going to be subject to an excise tax. Okay, next slide. Okay, now we're just going to get into a little bit more of the mechanics and how it looks on the Schedule A. So there's the first page of the Schedule A. There's going to be, you know, several boxes, and it's going to have several types of entities listed. So if you're a box 5, 7, or 8, then you're going to be filling out Part 2. And for this one, gifts, grants, and contributions are counted towards public support, and that includes government grants. And some government grants are more of like a fee for service, but it's still considered a grant. It's going to exclude program service revenue, capital gains, unusual grants, investment income. A big thing if you're filling out Part 2 is you have to track large donations. And the definition of a large donation is if it exceeds 2% of total support for this 5-year rolling period. And this is one of those line items that can be missed, because you have to, you know, track it separately if it's a large donation. And once it hits that threshold, it's not going to be considered public support anymore. It's going to be excluded from public support. Certain contributions aren't going to be excluded, even if they're greater than that 2%, and that's going to be support from a government, or if it's coming from another organization that is also filling out this Part 2 test, it's not going to be excluded from public support. It's still going to be considered public support. So you really have to look at the other 990 where you're getting these contributions from to see if they're going to be considered public support or not, if they're, you know, large enough to be more than 2% of total support. Okay, next slide, please. Okay, the Part 3, this is for your 509A2 organizations. And the big difference here is program service revenue is going to count as public support, whereas on the other test, program service revenue does not count as public support. But one thing to be cognizant on this test is certain grants are also not going to be considered public support, and that's if it comes from a disqualified person, and that's going to include people from the board. So if the board is giving money, you need to make sure you're tracking board contributions, because that is not from the public, that's from the board. And then there's also another test where it's program revenue that exceeds the greater of $5,000 or 1% of total support. And this is only for program revenue. Sometimes when people look at these two lines, you know, they get confused and they think, well, this contribution was more than $5,000. Do I have to take this out of public support? It doesn't count on 7B if it's a contribution. On 7B, it's only if it's, you know, your program revenue, not your contributions. So something to be cognizant of and not get those two tests mixed up. And so on this part, you have to pass 2 tests. And I like to call these the greater than, less than tests, or at least in my head, I always call them greater than, less than, because you want your public support to be greater than 33 1/3, and you want your investment income in certain UBI to be equal than or less than 33 1/3. So public support greater than, investment income less than greater than, less than. I'm not sure why they love 33 1/3%, but it shows up a lot. Okay, next one. Okay, this slide here is basically just highlighting the difference between the Part 2 test and the Part 3 test. And as you can see, the big difference here is the Part 2 test does not include program service revenue as public support. But if you go over to the Part 3 test, it does include program service revenue. But for the most part, they're very similar otherwise. You have the test at the very bottom to remove the excess of 2% of total support for the Part 2 test. And then on the Part 3 test, you kind of have a similar where you have to remove some items from public support. And that's going to be your gifts from the disqualified persons or the program service revenue that comes from one place that's over $5,000 or 1% of total revenue. So similar tests, just a little bit different. So this is just a side by side to kind of highlight the similarity and differences there. Okay, can move on to denominator, and same kind of idea here. Basically, your denominator is going to be your total support, but the big thing I like to highlight is capital gains and losses are never included on Schedule A. They don't go in the numerator, they don't go in the denominator, they're just not counted for Schedule A. Okay, can go to the next one. Okay, this slide here, I like to point out this one thing for Schedule A that it's not highlighted as well on the form. So if you are failing the 33 1/3% test, it's going to be really obvious. You're going to get down to the bottom and, you're not going to check the box that you passed the 33 1/3 test, and it's going to be really obvious. The one that isn't obvious is you're supposed to compare your public support to your support that you're getting from related activities, that income that you're generating from, doing your activities. And you look at them and you need to compare, because you should not receive almost all your support from related activities and an insignificant amount from the government units and the contributions from the public. So you just eyeball it. You just have to look. So many times I'll get a return to look at, and I'll be like, well, wait a minute. They're filing the Part 2 test, but they're getting hardly any contributions from the government and the public, and they're getting all this money from program service revenue. There's a disconnect there. They don't really pass Part 2, even though they're over 33 1/3. They really should be filing Part 3, because most of their income is coming from their program service revenue, and that's really a Part 3 organization, not a Part 2. Okay, can go on to the next one. Okay, where to find 990s? And this is important because if you're looking to see if you need to exclude it from public support, you have to look at that other 990 to see how they're reporting their income. So I used to always go to GuideStar, which is now Candid. That was always my go-to. And I feel like anymore you have to log in and do all this stuff. It's not as user-friendly. So now I've been using ProPublica. That's very user-friendly. You put in the name of the organization, type ProPublica after it, it pulls it up, and you can click on the 990 right from there. You don't have to log in, so that is a great tool. And then the IRS search is also a great tool. Okay, can go to the next one here. I think it's going to Natasha for lobbying.
I'm going to jump in real quick and just in the interest of everybody's time, put up that last poll question.
Okay, the fourth and final poll for those getting CPE, we'll do now, but we'll try to get through some more slides for those who can hang around for a little bit longer. So last poll, was the content in this webinar helpful?
All right, so we'll try to get through it as quickly as possible. So lobbying, a lot of people have a lot of questions about lobbying right now. There's a lot of things going on in the legislature. There's a lot of people worried about funding losses. So lobbying has been something that I've talked to clients with more this past year probably than I have in the last handful of years. But to talk about lobbying, we got to talk about the different definitions within the lobbying world. So legislation. That refers to federal, state, and local legislation. It also applies to referendums, initiative, or constitutional amendments. Lobbying is the practice of trying to influence members of the legislature to impact specific legislation or regulations. Specific is very important here. And influence is very important there. Advocacy is the practice of supporting or promoting a particular cause, idea, or policy. And then political activity are activities that support or oppose any candidate for an elected federal, state, or local office. Okay? So lobbying. There are two types of lobbying. There's direct and there's grassroots. Direct involves face-to-face interactions between a lobbyist and a lawmaker. These could include meetings, briefings, hearings. It could be your organization sending a lobbyist to speak to a senator or any kind of representative and asking them to vote a certain way. That's direct lobbying. Grassroots, on the other hand, involves a call to action for public support to influence policymakers indirectly. And we have all experienced this. So examples include organizing letter writing campaigns, phone calls, and petitions to demonstrate political sentiment on an issue. So all of us in our mailbox have likely gotten some kind of mailer that says, vote no, issue whatever. Vote yes, issue this, right? That is grassroots lobbying. That is a call to action for you to go do something. And it's lobbying because I'm asking you to do it. I'm asking you to actively go do something, right? There's a call to action there. But that's grassroots because you're not directly going to a representative or a senator or anything like that. So it's allowed for 501c3s, but cannot be substantial. Like a lot of things with the IRS, they don't define substantial. And so there's a lot of ambiguity there. Like, what does substantial mean? So if you are a 501c3 organization that normally does lobbying, there is an FO1H election that it will quantify substantial for you. So what that does, it's like a one-page election form that you opt in, and it gives you then a ceiling for what you're allowed to utilize for lobbying. Like, what can you spend in lobbying? And it is a 4-year calculation, so it does monitor it for 4 years. But it gives you something to look to for what substantial would mean. If you don't have that, the IRS could come in at any time and be like, well, what you're doing is substantial in their eyes, because there is no dollar value that is being applied. So for 501c3 organizations that are lobbying more frequently or intend to lobby more frequently, a 501h election is a good thing to consider because it is not a long election and it's pretty simple. So that is what lobbying is. On the next slide is what lobbying is not. So lobbying is not providing an analysis or research that is nonpartisan. It is not providing technical advice that was requested by a legislative body. So if a representative asks you to come talk about a specific thing, that is not lobbying. If you go to just share the research for what is going to happen, and it's not Republican, Democrat, whatever, it's nonpartisan, that is not lobbying. Appearances before or communications with a legislative body regarding the existence of the organization. You're just telling people that you're out here. Hey, we're out here. This is what we do. That's not lobbying. Communications with members about legislation. So if there is something out there that could possibly impact your organization, if some of this funding issues could impact your organization, and it's not you saying, go call your senator, go reach out to your representative. If you're just telling them about what this legislation is, that is also not lobbying. And then routine communications with legislators, not lobbying. Those things are all considered advocacy, right? You are advocating for your organization. You're providing this additional research, this additional information to help people understand how it could impact you. It is not you asking people or you directly asking someone to vote a certain way. So those activities are advocacy. And then the last piece of it is the political. And that's on the next slide. 501c3s are strictly prohibited from political activities. You cannot participate in any capacity. So you have to be very careful with that. That was very quick on lobbying. I know we've had a lot of questions before on lobbying and we're already over time. But that is something that is coming up a lot with our organizations.
Yeah, thanks, Natasha. Thanks, Anna Marie. I know we didn't get to questions, and I've just got so many myself too, just going through those. But if people do have questions, if you want to leave those in the Q&A, we can try to reach out to you if there or something, and we'll be sending out the slides and this recording. So, and then feel free to reach out to Anna Marie or Natasha directly too. You see their contact information there. So thank you, Anna Marie. Thank you, Natasha. We appreciate it. And so on behalf of Clark Schaefer Hackett and our webinar presenters, thank you for joining us and enjoy the rest of your day.